Hello and welcome to episode 15 of the Ask About Wealth podcast. As promised previously, we wanted to bring you a number of guests through this podcast, people who might give you new information, new knowledge to help you with your efforts to create and maintain wealth. And I'm delighted to welcome today Kevin Canning, who's MD of Quintas Capital. Kevin, thanks a lot for coming along today.
Thanks for having me.
One of the things, Kevin, I've certainly said to people is that, off-the-shelf products, if you like, products that are available on the high street are built for Mr. Average. Products built for less than average, and as I told you before we were recording, we're aimed at Ireland's high earners, are a little more in the shadows, perhaps, a little less obvious. Tell us about Quintas Capital, and I understand you've broadly three investment offerings for your clientele. Tell us about those.
Yeah, so Quintas Capital is a private market investment firm. We just deal in the private markets. We don't do anything in the public markets. Public markets quite a crowded space. The private markets, there isn't a whole lot of it in Ireland. We're similar to yourselves in that we only deal with high net worth clients. What we're known for most is we have a regulated EIIS fund. For investors, that would start at a 25k minimum investment, and that would be each year. But then some of our other investments would be, we'd have private credit investments, which are mainly real estate loans. And the starting point for that kind of investment would be probably 250 to 500k per investor. And then we have a managed equity line as well, where we buy at least 30% of a scaling profitable business. It's not venture, it's more private equity. And again, that's targeted at the high end of the market. That would be sort of a 250k starting point. So at the moment, the EIS fund is certainly the biggest portion of our business. We just raised a fund that was closed just before Christmas. And again, that's more like the entry point into our business for investors, that you can join with a 25k investment, and that's sort of an annual fund you can invest each year. Investors get tax relief back. I can touch on that more in a minute. And then the other piece of our business are more towards the high end of the market.
And you said private and public there. What do you mean by private when you say you're more in the private marketplace than the public one? Define that a little bit more for me, if you wouldn't mind.
Yeah, well, so, I mean, the public market is fairly self-explanatory in terms of you can buy a public business, think an Amazon, think an ETF, anything that's listed on a stock exchange. You can literally download 𝐏𝐫𝐢𝐜 𝐼BKR, whatever you want, and you can buy a company for as little as €1 later today if you want. Private markets, this is all stuff that's off market, it's all bespoke, it's one-off, and it's a lot harder to get access to that. That kind of thing is designed for high net worths, really. It's very hard to get access to it as a kind of retail investor.
And how do your clients get in touch with you then? How do you get to these high net worths, or how do they get to you?
Yeah, so it's a good question. I mean, our business was spun out of an accountancy firm. So an accountancy firm in Cork, Quintas Partners, that has since become Zenodin. And most of our original client base would have came from the accountancy firm. The accountancy firm had always done different types of investments, and we would have structured the investment firm out of it a little over 2 years ago. And a large portion of our client base comes from that. Now, there's 7 shareholders in our business. We all would have very detailed networks ourselves of different people who go into different types of investments. And look, our network is growing all the time. There's been several articles about us in different news publications over the last year. The currency would have some nice features there. Anytime we announce an investment, we announced an investment actually today of a $5.5 million investment in a creche business that are buying state-of-the-art new creches. That normally gets a big influx of investors come talk to us. We're always out, always meeting people. I spend more time in coffee shops meeting people than I do in front of a laptop. So we're also very big on LinkedIn. Absolutely love LinkedIn. It's an amazing customer acquisition tool. And yeah, we meet a lot of our investors through LinkedIn. Our EIS fund is a really big funnel into our business too. Like, we just raised 8 million for our fund to deploy this year. There's 135 investors making up that 8 million. A lot of people might put 25k, 50, 100k into an EIS fund, but some of those people have 10, 20, 30 million sitting in holding companies, and they're looking for other more bespoke investments in the real estate sector, in private equity sector, that you just can't get access to anywhere else in the market, to be honest. There's not too many options like this in Ireland at the moment.
And you mentioned the 𝒓𝒆 deal that's coming live today. Is that what you said? Tell us about that. Which one of these? Is that private credit? Is that managed equity? Is that EIIS? Or?
So it was an EIS investment. It actually straddles a couple of our funds and a private placement. So we raise a fund every year. So we deploy that fund into normally around 3 businesses. So we invested 2.25 million of our fund last year into it. That was the first part of the investment. That was done in November. It was only announced today because the funds were used to buy a 𝒓𝒆 from 𝐏𝐻𝐿's housing developer, and the contract wasn't signed until recently, so we couldn't announce it pre-Christmas, even though we had our investment done. And we've committed to do another 3.25 million of an investment from this year's fund. So it straddled 2 funds, and there was a bit of private money went in. Our shareholders personally invested in it too. It was an EIIS investment. It's a new 𝒓𝒆 business. We're buying high-end big 𝒓𝒆s from housing developers in Ireland. We'll hopefully have 4 𝒓𝒆s and 500 kid places open by September 2025. And all the investors get 50% tax relief on any money that goes into that business.
So we'll stick with the EIIS for a minute then, if we can, because my basic understanding of it is that the tax relief available on EIIS is somewhat dependent upon the underlying investment itself. And it goes, you mentioned 50%, but it can be lower than 50%, isn't it? How does that work? How does the tax relief across the different categories of EIIS work?
Yeah, and I suppose just taking a step back from that, I think it's important to point out that these rules changed about 18 months ago. Prior to that, it was always 40% tax relief. So regardless of what type of investment you put it into, you got 40% back.
So if you put 100 grand into something like that, you get 40,000 back, up to 18 months ago at least.
Correct, yes.
Okay.
Then the EU wanted to change things around a bit. To be fair to Irish Revenue, they didn't want to do this. Their hands were forced. They changed it to if you're pre-trading, which means you've never made a commercial sale, it's 50% tax relief. If you've made a commercial sale, it's 35% tax relief. There is another couple of rates, but they're not really important, or they're not really relevant. But that's sort of the 2 different categories. 50 if it's pre-first commercial sale, 35 if it's post-first commercial sale.
And does that mean you mentioned that you have 3 businesses within the fund, for example, or you will have is that the 2024 raise you're talking about? So what will the average be? Will there be some 35% funds there and some 50%, or will it all be 50%?
Yeah, so I mean, when you raise a fund or an EIS fund, they're all blind pooled funds. So technically, investors do not know where their money is going. You put money into a fund, into a bank account that's managed by a trustee, and you're backing the managers, which we are, to actually go and deploy that capital in a timely manner and into businesses that make sense. So the investors, since they've changed the rates, it's really difficult for the investors to even plan because they don't know what tax relief they're getting. Most funds have gone out, and I say most, there's only 3 funds this year who are still in business. There was a 4th, but I think there's only 3 this year. Have gone out and said it'll probably be a 35% tax relief just for prudency. We said in our marketing material it'd be sort of minimum of 42.5 because we had 2 50% opportunities secured already. We're now fairly confident we have a 3rd one, so we think our fund this year will have full 50% tax relief for everything. So out of the 8 million that we are investing, Revenue Commissioners will have to pay 4 million back to investors.
Oh. And does that does that effectively mean more risk for the investor? Because you tend to link tax relief with risk in that. Do you see that as more risk than the 35%?
Yes, yeah. In short, it is. But I suppose to give a bit more context around it is, like, take the creche, for example. So our funds are going into the creche business. They're a new creche a new creche business. They haven't traded before, so that's obviously inherently risky. Now, our funds are going in to buy freehold property, so our business will own the building. So there are assets there that kind of give investors a floor. We will stop the business from taking any debt in it, so our investors have some sort of protection there. Now, how do we mitigate that risk further would be, we know the founders, we've known them for a long time. They're putting in capital themselves, and their capital will, if this business was to fail, their capital would be wiped out, not the investors' capital. We would sell the assets, and investors would get a large portion of their investment back. Now, I suppose your question was about sort of the risk. We could invest in that business again next year. The cap for 1 year is 5.5 million that can go into any one business. But if we invested next year, it should be a lot less risky, because it would probably be a profitable trading business at that stage that's going well. But investors would only get 35% tax relief. So we're trying to manage the risk there. If we are going into 50%, there needs to be, it needs to be a very compelling story. I would not invest in, say, some medtech startup that's saying, I'm going to cure cancer, and they want to do 8 years of R&D. That's not what we look at.
Yeah. And it's interesting you said, or I think you said earlier, that some of your shareholders are investors themselves in some of these projects, and the promoters in the case of the creche are investors. I've certainly said, it's important for any investor to see that the person doing the promoting has skin in the game. When you, just from your personal side, Kevin, and looking at giving our listeners something to take away, when you're looking at an investment opportunity, what are you looking for? What are the 2 or 3 things you say are vitally important that to identify in advance of being able to make a decision to invest?
Yeah, look, I think skin in the game of promoters is such a huge one. Like, you loved it, you meet founders so often, you're saying, what have you put in here? And you might hear the word sweat equity used quite a bit. And I'm like, well, lads, I want to see you actually put in hard cash here, that if this business fails, you're actually losing out. So that's always a key one, especially with our EIS investments. We normally require that they put up at least 10% of the capital. And we're talking 10% of big numbers here. 10% of 5 million is a significant chunk for any founder. So that's a major one. Certainly going forward, we look in our EIS investments, especially, and our private credit stuff, there's generally a real estate angle. That gives a good floor to our investments, that we can get some, either security in our private credit stuff, or with EIS, we'd have a preference share in the building. And
who does the valuations of those underlying assets, Kevin? Do you get them independently valued, or?
So if we were say for the creche, there's no need in that. We just bought them off 𝐏𝐻𝐿's. So sorry, the first one was bought off 𝐏𝐻𝐿's, so it was an open market negotiation.
Yeah. So the price is set by the market in that case.
Yeah, correct. I mean, we're looking at an apart hotel in Dublin at the moment. It was bought on the open market. We are looking at a paddle court fit out and plunge pools and sauna fit out in Cork City at the moment as well, and that would be, again, a warehouse that was bought on the open market. So in terms of when we're going into an investment, it's normally there's a real estate angle there that they're buying on the open market or developing, and we'd have contractors and stuff that we'd get valued. If you're talking about further on down the line, we would generally get independent valuers.
Yeah. And so making sure the promoters have skin in the game, was one of the things you said is important there. Perhaps having some sort of real estate backing, some sort of security that underpins the investment. Is there anything else you're looking for?
Yeah, and like as our investment thesis has progressed, we love simple businesses that make cash. Like there's a lot of, I had a chat with Dean earlier about, tech businesses and this sort of stuff, and through HBAN there'll be a lot of that, and it's great for angel investors, but that's not what we look at the moment. The more simple and basic the business and the more cash flow it generates, it's exactly what we want.
And what kind of return are you looking for in these investments? For the investor, what kind of returns are on the cards, do you hope?
In our EIS fund, and like using the 𝒓𝒆 as an example, our investors get 50% tax relief up front. So you put in 100K, you get 50K back. That can happen within, 3 months. I am a personal investor in the 𝒓𝒆, same as any other investor. And yeah, I have my tax cert in with revenue now to get a refund back in the next couple of weeks. And I would have invested just pre-Christmas. That investment then needs to sit for a minimum of 4 years, and then we get it redeemed with a coupon, provided the business is trading well. Overall, we normally work it out on an IRR calculation, and our EIS investments with 50% tax relief and a 20% coupon on the other side, which means 100K would turn into 120K, you would be looking at an IRR of in and around 20%.
Well, and that's including the tax relief?
Tax relief, yeah, okay. And the coupon.
Okay.
And that isn't reinvesting the tax relief in anything else. So like I would always, talk to people.
Sure, if you get the 50 grand back, don't blow it.
Yeah, don't blow it. But I mean, like, even if you sat that on deposit for the next 4 years, it could still add to your IR calculation without putting any more risk on it. Yeah. I mean, when we were investing in the 𝒓𝒆 pre-Christmas, you're looking at it. If you've money sitting, my money was sitting in a Revolut account earning 3% per annum and paying, 41% exit tax on that 3%. So it's coming out with about 2.6%, I think. I transferred it into the 𝒓𝒆 and got half it back should have it back within 2 months. Yeah.
And what does the 𝒓𝒆 have to do to get that? Because in very simple interest terms, that's 5% a year, isn't it? Over 4 years. What does the 𝒓𝒆 have to have done for that to be the outcome, if you know what I mean? What does it just have to be still trading in 4 years? Does it have to be profitable?
Pretty much. I mean, so when we go into a business, we're like a redeemable preference share. The founders would be an ordinary equity share. Mm-hmm. So we're a little bit more like debt than we are more straight equity. So we don't own a percentage of the business. So like, we set a coupon to be repaid with the capital after 4 years. Okay. So yeah, it does just need to be.
And I presume you have to see that the people paying back this money have the wherewithal to pay that back at the end of 4 years. So are they creating a sinking fund in their business to do this? Or are they depending on bank finance down the line? How do you look at that?
Yeah, and look at the sinking fund's an interesting one. I wish they could, but it's actually specifically not allowed under EIS legislation with revenue. So yeah, as much as I'd love to have to put a sinking fund, you can't. But you do stop them doing certain things. So like, we're more like, we're an investment manager for them. We help them grow and scale. We're very supportive of businesses, but we have to represent investors and investors' best interest. Yeah. We restrict salaries of founders. We restrict any sort of dividends. We'd restrict any sort of asset stripping. We're very strict with these businesses, and you have to be. There's a lot of EIS investments out there that do not have an investment advisor. Yes. And if they are doing the redeemable preference share, it's kind of similar to, going to a bank and writing your own loan terms. You're never going to settle for that, so I don't think any investor should settle for that.
And tell me, let's fast forward to 2029, and the people are getting their 120% back, hopefully. What's the tax liability at that point in time?
I wish this was an easy answer too, but there's never easy answers in the Irish tax system. It can be CGT or it can be income tax. Now you're taxed on the 20k uplift as opposed to, if you think about a normal investment, you put 100k into a stock market and it only cost you 50 and it ended up being 120, you would pay tax on the full uplift from the 50 to the 120. So you'd only pay the uplift from the 100 here to the 20. It's income tax at up to 52% if the company redeems the shares before 5 years and CGT after 5 years.
Okay, so
but someone could also buy your shares. A company could come in and buy your shares and convert them into equity, and that could be CGT.
Right. Okay. And does that mean that the 4-year investment is a 5-year investment then to get the lower tax rate? Or
no, and look, I have this, and look, we can't do we have to do a one size fits all. We can't say some investors, you redeem after 4 years, you redeem after 5 years because you want CGT. You remember, some people use EIS investing like this as sort of retirement planning. We'd have an investor who would have started doing, say, 100k investments at the age of 50, did it for 5 years until he turned 55, and then he retired 5 years before his pension, and he's getting them paid out now at the moment. So he actually wants it to be income tax because he doesn't have employment income anymore.
Right,
so
and he can use his allowances.
He's using his allowances and tax credits. So not everyone wants CGT, even though the headline figure is higher.
I think, one of the things you've been telling us about EIIS, Kevin, and certainly my view is that tax is the greatest obstacle to the accumulation of wealth in this country. In fact, it's the greatest obstacle to the accumulation of wealth throughout the Western world. And the legitimate avoidance of tax is a key element. So, you mentioned earlier, and I think there's something in this, that EIIS isn't about making one investment, I would suggest to our listeners. It's about making regular investments, recognising that there will be, I suppose, failures in this space. Can you tell us, have you seen a failure in your own world or in previous lives that, I want people to understand warts and all, as it were. The tax breaks on EIIS are fantastic, and they give an opportunity for people to, make decisions about where their tax goes. When water charges came in out in North County Dublin, where I live, I was one of the people who didn't pay them. And I didn't pay them because I didn't believe my water charge would be going where it should go.
Aren't they all taxes?
The problem is it all goes into the central budget and gets spent, nothing to do with local. So have you experience of super successes in the space we're talking about, and indeed maybe even the warts, the odd failure?
Yeah, like when you're talking super successes, the goal of it isn't really to have a super success because it is a capped return. It's like giving a loan to a business for 4 years. So like a super success is get your tax relief on time, getting your money back on time. So like thankfully that happens most of the time. There are definitely delays. Like I would not be telling any investor to go into it and say, yeah, on day 1 of year 4, your money is coming back into your bank account. That's just not the case. It will be sometimes, it won't be other times. In terms of failures, thankfully, Quintas have been doing this. I've been involved with Quintas for about 6 years and running the business for the last 3. We haven't had any failures since I've been involved in it. Going back 20 years, there have been one or two that haven't redeemed fully. But like across the industry, like the industry is the wild, wild west. It has a bad reputation for a reason. There's loads of people, as we were saying earlier, put an ad in the Sunday Business Post and people just send them checks in the post with no legal documents, or even talking to the company founder or knowing what the terms of the investment are. Like I meet so many investors who've had one bad EIIS experience and they're just like, no, never again. EIIS is a scam, this kind of stuff. And like, you just need to go to a reputable professional advisor, like we pay a lot of money to be regulated in this space. There's only 3 of us in the country who pay that money to be regulated in this space.
Yeah. And what in a protection terms, what does that regulation mean for the investor?
Well, investors are protected by the Consumer Protection Code. Like that's huge. I mean, we have to turn down investors all the time because they're not suitable for it. We have to go through the same selling process. I hate the word selling, but as any financial advisor, we have to do risk questionnaires. We have to understand if people have the tax to save. We have to meet them. There's loads of conditions we have to do that other firms wouldn't have to do. And, we onboarded 135 investors in December for our fund. It's a logistical challenge to say the least. But yeah, look, we do it to try and be best in class and, have...
Yeah, it's interesting what you say about the ads on the back of the business post or whatever. I've talked before about, the 2 predominant human emotions being fear and greed. And greed motivates us to do things. Greed is what makes people send the check, because they're looking solely at the tax break.
Yeah.
I'd rather do anything than give the tax man this money. Fear is, as you say, the bad experience. But just because you had a bad experience once doesn't mean you'll have it again. The key, from listening to what you're saying, the key is making sure you deal with a properly regulated advisor. And that's you. You're taking some of the risk out of that for clients through your regulatory process. And then, as you said too, I suppose, not to expect super success. That's not what it's about. It's about, understanding what what your potential outcome can be. Is there any danger of people losing 100% of their money if they go into an investment with Quintas, an EIIS investment with Quintas Capital?
If you go in through the fund model, it's highly unlikely, but I would never say never. Like one of the beauties of the fund model is diversification. You're investing in, say, 3 to 5 businesses instead of one. Your money is being spread. There is a lot higher chance of you losing everything if you go into one business, and especially if you pick that business off the back of the Sunday Business Post without being a professional to be able to do the DD and understand how that business operates. So that's the main sell of a fund. You pay for the privilege, and we have several investment professionals who work closely with these businesses, sit on boards. I'm up here today, and I had a 4-hour meeting with one of our portfolio companies with 2 of us, helping them to restructure and right size the business. And look, you're not going to get that if you go directly into it.
That was another question I was going to ask you. As the fund manager, as it were, as the advisor in this space, are you taking a seat on the board of these businesses? Are you involved in that way in the management of the business?
Yeah, so we don't get involved in the day-to-day management of a business, and even with private equity and our managed equity, it's very dangerous to get involved with the day-to-day management of a business, because if you do, they become too reliant on you, and it's really hard to pull yourself out of that. So and board observer is great, and we would take board observer positions, but that's at best once a month. You're there more of a board observer position is great just to hold people accountable for what they say they're going to be doing and be an outside voice and being there for representing investors. But what we would do is we'd have a founders program. We got all our founders together. Last year we did it 4 times in person and 4 times online, where we actually do sort of peer-to-peer learning with all of our founders. They get to know each other. They learn from different industries. We have tech businesses learning from, food businesses. They all have the exact same problems of running a business, but just in different ways. So we do that kind of stuff. We also help businesses with KPIs, restructuring when needed. Look, we really earn our money when a business gets into trouble.
Yeah. And you mentioned, when I was looking at your website earlier, is there an ideal customer in your head for Quintas Capital?
Yeah, our ideal customer is an Irish SME business owner that is either quite profitable and probably has a holding company and they're putting money up to that holding company, or they've had an exit in the last 12 months. That's the main business customer we have. You know, if you're talking EIS fund, we'd have a lot of people who are high earners who work in the tech industry and that kind of stuff. They generally don't get involved in kind of the private credit side or the private equity side, but they're big into the EIS because they can shelter income from share options and rental profits, which you can't do with pensions. But on the other side of our business, ideal customer and all our investors that we deal with are generally Irish SME business owners who are working towards exits or had exits. And we do help a lot of people with exits too.
And tell me a bit about that. I mean, you know, often I mentioned earlier to you before we started recording that I lecture in a private business college in Dublin. One of the things I often told the kids was, as an investor in private business, you have to be a bit of a spook in the sense that spies are taught every time they walk into a room. They don't walk into a room they can't get out of. Every exit they must know how to get out. What are in terms of the private equity maybe side, what are the exit mechanisms for investors?
If you're making a private equity investment, so like our typical model now is we'll buy 30% of a business, minimum 30, so 30 to 40%. So founder normally maintains, the founder will maintain sort of majority share. We bring in investors and we invest ourselves too. We'll invest from our shareholders, co-invest with the other investors. So in terms of an exit mechanism, everyone is going to exit together. And we would try and scale the business to exit to generally probably another private equity player. But part of what we do is position companies to actually get there. Now, I say this with the caveat of a lot of our shareholders and stuff have done this previously and have been involved in these types of businesses. But this is a new offering for us. We nearly got our first investment done in our private equity line in November of this year, but kind of fell apart at the last minute through no fault of our own. But we will be looking to make 2 investments this year in the sort of 4 to 6 million range.
Okay, and as you say, that your clients are investing in these, and go back to the holding company, because we get quite a number of questions around holding companies and through DMs and stuff. These are the holding companies making the investments you're talking about in terms of the private equity stuff, or the private, or the debt, the private debt stuff.
Yes, so I suppose like most business owners in Ireland tend to have a holding company. Main benefit of it is when you go to sell your business, you can take it all tax free, but it's stuck within a company. The other main benefit if you're not selling your business is that you can pay dividends up to your holding company and just have cash kind of siloed away. That business then is free to do it at once. You know, it can make investments. It could buy real estate. It could invest credit into real estate, which is the way I way prefer investing into real estate in Ireland than actually buying an asset. Or it could do sort of private equity investments. The last thing you want to do is do that off your trading business balance sheet, because if you go to sell your business or do something with your business in a few years, no one's going to want to buy something if it owns a load of residential real estate or something randomly in a coffee business.
Mm-hmm. You said there about investing in property, I think, and you were saying you'd much prefer to invest in property debt than property itself.
Yeah.
Expand on that a little bit for me, if you wouldn't mind.
This is probably a bit of a contentious take in Ireland, in that everyone in Ireland wants to own real estate. Yeah. At the higher end of the scale, we've people that, you know, they might have had 100 million exit and they go away and buy a shopping centre. They want the stable rent, they want the asset appreciation. At that size, you can probably put in a professional asset manager and it's okay. But at the smaller scale, I meet people all the time, you know, they might have had a 1 to 2 million sale and they're like, okay, I'm going to go away and buy 3 apartments and manage these. And I'd always say to them, like, do you want to be a landlord? Like, you've worked hard all your life running a business or squirreling away money. Like, do you really want to become a landlord now? That sounds miserable to me personally. I'd hate to be a landlord. So like the way we would look at that is you should lend to people. Like the Irish banking system, it's not fulfilling its purpose at the moment in terms of loans. So the private credit industry is scaling massively in Ireland and Europe. If you look at the US, private credit is huge over there. It's about 80% of businesses now get money from private credit, whereas in Ireland it's about 20% and in Europe. But it's growing really, really quickly. Our private credit industry hasn't really taken off yet. There's a few funds mainly funded by like Enterprise Ireland, ISIF, a couple of institutional capital players like the big private equity guys, KKR, BlackRock, these kind of businesses. There isn't too much private credit in the Irish market yet, and that is sort of a place we're going after significantly because there's a lot of demand from investors for it.
And you're talking about relatively short-term finance there, are you? What kind of terms are you talking about? What kind of returns would the loan provider get in that case? 12
to 36 months is kind of the way we would look at it. Anything above that, people aren't really interested in it because like 36 months is a long time out. They might have something planned for their money in that time, or they might need it. On the really safe and secure side of things, so we would have done a loan into a real estate building that had a 20-year lease with the HSE last year. It was €1 million loan. That was at the lower end, and that was 7.5% per annum for 2 years. At the upper end, even real estate asset-backed one, we're looking at one at the moment that is 14.5% per annum over 2 years. So anywhere in that space, if you get into the cash flow lending private credit. So as you were saying, if you bought a property in Dublin, for example, a residential, I mean, broadly speaking, rent today is about 7%. That's roughly where it seems to be. So you're saying the alternative perhaps to that, while sticking with the same underlying asset being property, there could be a 7.5 to even 14% return. Yes.
Without all the hassle factor of being a landlord.
Yes, and that's way more attractive to me as an investor.
And
personally.
How is that tax? Is that income tax? Is that capital gains tax?
So within a corporate structure, it would be the same as rent, with the caveat of you actually can set up a lending business in Ireland. You can have a lending holding company, and if you have the right financial expertise in it, that can be taxed at 12.5%, which is a really attractive rate.
So you can set up a company which commercially lends money, but is deemed a trading business effectively in getting the 12.5% rate. Wow, as opposed to the 25% rate which would exist.
25 plus close company surcharge.
Plus
could bring
close
it to 40.
Company surcharge, yeah.
I always look at it being 40.
Yeah. Kevin, look, it's been great. Again, thank you very much. Hopefully, I've no doubt I've learned something here today, so thank you for that. With any luck, the listeners have learned something too. We'd certainly maybe like to get you back at some stage in the future to talk a bit more detail about some of the others. I think we focused predominantly on EIIS today, but tax is one of my favourite subjects. As I said earlier, it's the greatest obstacle to achieving wealth and prosperity as far as I can see. But thank you for your time today. Thank you for your expertise, and hopefully we'll see you again in the future.
It's great. Thanks very much for having me, and great to hear you love tax so much. Everything I look at's with a tax brain, so
Excellent.
it's great.
Thank you very much.